The Equal Credit Opportunity Act, better known by its acronym ECOA, was enacted in 1974. The ECOA has four main parts. These are: first, the definition of discrimination in credit lending. Second, the credit applicant's rights to a notice of credit decisions and related information. Third, the actual notice of the ECOA applying to the borrower, the credit decision made on his application, and the reasons for the decision, approval or denial or change. And finally, record keeping. The ECOA, as a financing regulatory law, is very broad. It covers all types of credit transactions, regardless of whether they are for a consumer or a business seeking commercial loans. And all lender types are included in this scope as well. Now, let's discuss what is prohibited under the ECOA. Under the ECOA, when a consumer applies for a loan, a lender is forbidden from the following. First, no applicant can be persuaded or stopped from applying, or have an application denied based on race, color, religion, national origin, sex, marital status, age, or due to receiving any kind of public assistance program. For example, a woman cannot be denied the ability to apply for credit because she receives woman, infants, and/or children monthly support. Second, using an applicant's race, gender, or birthplace as a factor for a credit decision is prohibited. However, this rule does not bar an applicant from providing the same information voluntarily. Applicant immigration status, on the other hand, is allowable because it goes to the heart of whether the person borrowing funds will be in the country long enough to pay them back. Third, varying the terms of lending on an applicant due to being a member of a protected class, race, gender, religion, national origin, etc., or for a reason associated with a protected class is also prohibited. For example, charging a higher interest rate on a borrower because he is buying a home in a predominantly African American neighborhood. And finally, asking for information on the marital status of an applicant to determine if he or she is divorced or widowed. The lender can, however, ask if a person is married, single, or separated. A common issue prior to the ECOA was with lenders not wanting to lend to divorced or widowed women, assuming they couldn't generate sufficient income to pay a loan. There are some additional concerns to watch out for regarding marital status. Lenders have some restricted leeway which they are able to use carefully when asking for information from the borrowers. It was recognized that lenders should be able to get to the true nature of an applicant's income status, but not use marital status alone as a reason for credit approval or denial. So, under ECOA, marriage status information requests are restricted as follows. First, a lender can ask about marital status if an applicant is seeking his or her own individual account for unsecured debt. This information request type is most common in states with community property laws, i.e., where being married automatically gives a spouse 50% control of any property gained during the marriage. Second, the information on marital status can also be asked for at any time in any state where the account would be shared with a spouse or where the property is used as collateral. Again, this is needed in order to assert clear title status. Third, any information about children or having children is not allowed to be requested either. Dependent care costs, however, can be requested. And finally, child support, alimony, or other legal arrangements can be sought out by the lender only if they warn the applicant in advance that he or she is not required to provide such information, and that choosing to provide the information is deemed voluntary. However, if the applicant is paying out support expenses, then they are fair game for review. Interestingly, age is not an area to worry about in terms of discrimination. Age, as credit criteria, is restricted to 1. Whether the applicant is too young to enter into a contract, meaning the applicant is under 18 years of age, or 2. The applicant is over 62 years of age. Anyone's age can be used as an indirect factor when it has an impact on income. For example, if an applicant makes $100,000 annually, but he is about to retire in a year, that would be a big issue when deciding on a $50,000 credit line request. Now, let's discuss what the ECOA requires of lenders. The ECOA requirements for lenders begin with providing an application to a potential borrower in terms of notice and continue into the decision to approve or not, as well as how that decision is communicated back to the applicant. For all applicants, the following application notice from a lender is the best advised approach. Notice: the Federal Equal Credit Opportunity Act prohibits creditors from discriminating against credit applicants on the basis of race, color, religion, national origin, sex, marital status, age, because all or part of the applicant's income derives from any public assistance program, or because the applicant has, in good faith, exercised any right under the Consumer Credit Protection Act. The federal agency that administers compliance with the law concerning this credit is the Federal Trade Commission, Division of Credit Practices, 6th and Pennsylvania Avenue, Northwest, Washington, D.C. 20580. So, what is an adverse credit decision? Under the ECOA, an adverse action can be any of the following situations regarding credit. Number 1. Denial of credit to an applicant. Number 2. Approving credit, but the amount offered is less than what was originally requested by the applicant. Number 3. Denying a credit increase on an existing account when it is requested. Number 4. Closing an existing credit account. And number 5. Changing the account terms that have a negative impact on the account holder. However, an adverse decision does not include an across-the-board change by a lender to all of its accounts at the same time, even if negative. A common example would be a fee increase for cash advances on all credit card accounts. Since it affects all account holders, it is not an adverse decision under the ECOA, even though the effect means a cash advance is now more expensive for all the customers of a given lender. In terms of the credit decision process, lenders under the ECOA have to make sure their systems follow the law as well. For example, creditors are allowed to consider whether an applicant has a dedicated communication tool, for example, a confirmed phone account. This is logical, as creditors want to be able to contact the borrowers in case problems come up. Lenders also can't apply or offer discounts to a borrower simply because of gender or marriage status. Other business practices banned from being a reason for denial include whether the applicant depends on an annuity, part-time versus full-time work, or if an applicant receives a pension or Social Security. Finally, income from alimony, child support, or another legal marital arrangement cannot be the reason for reducing the credit offered. Lenders can, however, require documentation of income sources to validate them. For example, Sarah gets half of her income from alimony and then works part-time as a graphic designer. Asking for both her work and alimony income would be a legitimate request by the lender in order to approve the credit. The decision notice to the applicants under the ECOA depends a lot on the type of customer. The ECOA does make a difference between customers who are large-scale borrowers versus those who are smaller or private consumers. For commercial borrowers, the decision notice differences are specific to their revenue levels. For example, if a commercial applicant generated over $1 million in prior year gross revenue, or is seeking credit via a line, or credit or a trade line, then the creditor providing the decision must 1. Provide an ECOA notice, which can be in writing or as a verbal notice. 2. Provide a credit decision within a reasonable time once the application is submitted. 3. Give a clear decision on a credit approval, provide a different offer than what was requested, or provide an adverse response. And 4. Provide a written response within 60 days from an adverse decision, where the response has to include the reason for denial and the general ECOA notice. For such a response to be provided, the applicant must submit an official request. On the other hand, if an applicant was a smaller business, such as one that generated less than $1 million in revenue, the creditor has to provide the credit decision within 30 days once an application has been received. The noticing and archiving of records is the same as the larger company applicant. So, which approach is better with business customers? That decision depends on the given creditor's operations and its customer base, at least in terms of commercial accounts. Some creative lenders have simply decided to combine both groups. A typical hybrid approach would 1. Provide an ECOA notice in writing to anyone right from the start. 2. Provide the decision notice within 30 days of a received application. And 3. Provide the reason for any type of adverse action. Another area of credit noticing that gets some attention is that of co-applicants. Under the ECOA, only one of the co-applicants on a loan application has to be notified about a decision, not both. So, if Henry and his partner Joe go in for a loan as co-applicants, the bank lender only has to notify one of them of the decision. However, many lenders just provide the notice to both co-applicants anyways, as it avoids unnecessary conflicts. Next, let's discuss record-keeping requirements under the ECOA. Like other types of federal law, when it comes to financial transactions, record-keeping is a big part of the ECOA. Specifically, the ECOA is intended to create a paper trail so that a decision can't disappear quickly after it's made. On the consumer side, a lender must keep and maintain an applicant's records for up to 25 months. On the commercial side, creditors with applicants who generate more than $1 million annually in income must keep records at least 60 days after providing an ECA notice to the applicant. Where the credit line was not extended and the applicant wants to know why, the lender has to keep the records on file for 12 months, a full calendar year. The same applies if the applicant specifically asks for the records to be kept in place, regardless of credit being approved or not approved. And record retention applies completely in any case where an applicant generates less than $1 million in gross revenue annually. What you've heard so far in this lesson is a detailed overview of the ECOA. While the ECOA will not directly impact your day-to-day actions as a real estate agent, it is important to know what rules and regulations lenders are required to follow when determining if a home buyer is eligible to receive a loan. A client's ability to borrow is fundamental for purchasing a property, and you must be aware of what could impact a borrower's ability to purchase a property. About 95% of homeowners are taking out a mortgage loan in order to afford purchasing a property. So, in most cases, you will only be able to make a sale if your client has the ability to borrow money for their mortgage.